Wall Street in chaos as the U.S. lifts China tariffs following a bond market collapse. Tonight, how a tariff shock collided with a historic spike in Treasury yields and forced a sudden policy reversal. From New York to Shanghai, the repercussions are global, touching mortgages, 401ks, and the banking system. We break down the timeline, the facts, and the stakes. When bonds broke, policy blinked. This is your deep dive into crisis to clarity. The first few months of 2025 felt like a strange and unsettling calm. Global markets were navigating stubborn inflation, rising interest rates, and simmering geopolitical tensions. Investors had grown accustomed to volatility, a nervous energy humming beneath daily trading. The 40-year trend of falling bond yields, a tailwind for asset prices, had decisively reversed. Since early 2021, the U.S. 10-year Treasury yield climbed relentlessly, ushering in higher borrowing costs economy-wide, from corporate boardrooms to family kitchen tables. Banks sat on a precarious pile of unrealized losses. By Q1 2025, U.S. banks held about $620 billion in paper losses on securities portfolios. The 2023 failure of Silicon Valley Bank lingered as a reminder of bond loss risk. Against this backdrop, the second Trump administration signaled a more aggressive trade stance. Rhetoric sharpened as both sides dug in. Average U.S. tariffs on Chinese exports climbed, up 36.8 percentage points since January 20, 2025. Businesses struggled to plan. Consumers braced for price shocks. Every report, central bank statement, and political speech was scrutinized for clues. Markets hovered near highs but felt fragile, supported more by momentum than fundamentals. The breaking point arrived on Wednesday, April 2, 2025. The White House unveiled sweeping new tariffs, dubbed the Liberation Day tariffs. Not a tweak, a massive escalation on nearly all imports with a focus on China. The stated goal: protect American industry and rebalance trade. The immediate effect: a shockwave of fear through global markets. The fragile calm shattered. The reaction was swift and brutal. Higher tariffs signaled higher costs and stronger inflation pressures. Households squeezed, demand dampened, earnings eroded. In 2 days, Dow 4,000 points, 9.48%, S&P 10%, NASDAQ 11%. Roughly $6.6 trillion erased, the largest 2-day loss in history. Retirement accounts, pension funds, and portfolios saw years of gains vanish. Contagion rippled across global markets. U.S.-listed stocks plunged about $7.7 trillion in days. Typically, panic sends investors into treasuries. In April, the unthinkable happened. Investors sold bonds aggressively. Prices fell and yields skyrocketed. The 10-year surged to 4.5% by the morning of April 9th. The 30-year jumped 54 basis points in 3 days, biggest leap since 1982. This wasn't normal volatility. Market plumbing was under extreme stress. Reason 1: tariffs were seen as massively inflationary, forcing higher for longer rates. Low coupon bonds looked unattractive. Investors sold. Reason 2: a crisis of confidence in U.S. policy predictability and fiscal discipline. A plunging bond market threatens the government's ability to fund itself. When stocks and bonds fall together, panic can spiral fast. Traders dubbed it America's Liz Truss moment. Like the UK in 2022, markets rejected policy deemed inflationary and reckless. Bond vigilantes drove yields higher, a market penalty that forced a rethink. Under intense pressure, the administration pivoted. A 90-day pause temporarily suspended most tariffs, especially on Chinese goods. Language cited ongoing discussions and further review. Markets heard backing down. Reciprocal rates aimed lower toward 10%, with suspension extended to November 10, 2025. Objective: break the fever, calm bonds, and steady markets. The drama on trading screens translated into pain at home. Millions saw retirement balances hit hard in days. The 10-year Treasury heavily influences mortgages, auto loans, and credit cards. Freddie Mac data, 30-year fixed rose from 2.7% in 2021 to 6.7% by 2025, and could surge further. Higher yields lift borrowing costs for cars and revolving credit. Even as yields eased off peaks, lenders may be slow to pass relief amid volatility. Uncertain policy, volatile markets, and higher capital costs chilled investment. Hiring slowed. Wage gains faced headwinds. Post-suspension, a ferocious rally returned stocks to all-time highs. By October, the S&P 500 and Nasdaq printed fresh records. But analysts warned of froth after a 36% surge from April lows. Core risks persisted. Temporary tariff truce, high rates, and banking bond losses. Some called for a pause to consolidate gains. Markets wrestled with FOMO on the rally versus fear of fragile underpinnings. Banks still faced hundreds of billions in paper losses. Tariff relief was suspended, not repealed. Tensions remained. Beneath new highs, a wall of worry stood tall. Experts agreed. The stock crash grabbed headlines, but bonds forced policy change. A plunging stock market hurts your 401k. When bonds plunged, things got really bad. The Treasury market is larger and more systemically important than stocks. Soaring yields directly attack banks, housing, and government funding. Faced with a clear and present danger, the administration suspended tariffs. The truce is fragile. Underlying disagreements on trade, tech, and security persist. Even powerful governments operate within capital market constraints. Lesson: fiscal and trade policies have consequences. Bonds arbitrate credibility. Temporarily lifting tariffs pulled the system back from the brink. For now, watch inflation, central bank moves, and bond yields. They shape your borrowing costs. Stay diversified, stay informed, and plan for volatility. What does this mean for the global economy? Share your perspective below. Like, subscribe, and comment for more verified breakdowns. Watermark. Snap Explain.